thanks very much. A Biden presidency was supposed to mean slightly lower fiscal stimulus, which means it's less bearish for dollar, which means that it's less risk positive for equities. That's not panning out. Are we getting swept up in a bit of euphoria here, or you think, it's warranted?
No, I think, the a clean sweep of the Democrats would have meant a far larger fiscal stimulus. Although I think the gridlock in the US has meant that clearly they'll be reined in. And that has been certainly perceived as dollar negative. It's possible that I think the markets also feel that the Fed will have to do more of the heavy lifting relative to the fiscal. And because of which, you're seeing this enormous expansion and acceleration of price earnings. As I've been kind of alluding to this in the past, the primary trend really has been this very large, huge amount of quantitative easing and global liquidity that has been, unleashed by the central bankers, and which has meant a acceleration of price earnings for equity assets. So I think that's really driving the primary trend, and I think that primary trend is intact. In fact, I think it has some more legs to go from here.
So PE expansion in equities could continue. Rajesh, morning, and thanks so much for joining in. And congratulations, your fund has been one of the nominees for the best hedge fund. So congratulations on that. So from a portfolio point of view, what is the way forward? How should we approach it? Do you think banks have more catch up to go? Will IT and pharmaceutical continue to lead the way?
Well, I think a balance of, my sense is that the existing plays, what we call a barbell approach, which is, things like, platform companies or IT services companies, and you include that with the banks. I think certainly, banks have really surprised, on the upside as far as their results are concerned. I think the market was expecting far larger credit losses, or at least anticipating a lot of credit losses to come as we move forward. But I think the conservative provisioning by the banks, as well as across the board, guidance that credit costs will not spike, post-COVID, has demonstrated the resilience of our system as well as for banks. And therefore, the worst case that was being priced in was far away from the truth. And therefore, you're seeing this massive repricing of banks to the positive side. And I think probably even that has some legs to go. So I would say that a balanced portfolio of this barbell approach, which is, IT companies, platform companies, along with cyclicals such as banks, will do well for the future.
Platform companies, Rajesh, which ones are you?
The largest market cap company in the country.
Okay. And traditional IT services as well.
Yes, I think a lot of IT services companies have told you that this is the beginning of our tech cycle, and the next 4 to 5 years would mean a lot of technology adoption by the Fortune 1000 companies, so as to say, and that could mean higher spending in technology, greater market share gains for IT services companies in India, and therefore a good demand environment. Plus, I think they're rationalizing costs enormously in terms of the rental costs or work from home, which could mean higher offshoring, which are high margin, outlets for these kind of companies. So I would say that the next few years look fairly positive for the IT services companies. And, I think as Mark Anderson would say, software is eating the world. And I think probably that has got an acceleration, post-COVID. So I would say, yes, IT services companies will continue to do well as we move forward.
Okay. So IT, banks, and India's largest market capitalization company on your buy list. Rajesh, how worried should we be about rising COVID cases in US and Europe? The numbers are alarming. So, for instance, US reported, 126,000 fresh cases, just now, and the July peak was just 76,000. In UK, we're talking about 25,000 fresh cases. In July, that number was as low as 800 cases. So, from a market point of view, can this result in a dip, considering we are pretty much at all-time high levels?
So the market focuses on one thing at a time. So at this moment, it was only focused on the US elections and the implication of that for the markets. Now that that's out of the way, I think it'll start focusing on the rising COVID cases. And absolutely right. I mean, this has the potential to, I don't know how many companies can withstand a second wave. Business models which are weak could get weaker and could result in more bankruptcies. And that would be the fear of the market if there is a second wave were to be of any large magnitude. I think the market is not reacting at this moment to these COVID cases is because the number of deaths. So the number of deaths at this moment are not in a proportion which will scare the markets. So if that were to rise, only then I think the markets will react negatively. But yes, it's a risk to even the primary trend that I alluded to earlier. But I think the market was focused on elections, and now it will focus on the COVID cases as we move forward, particularly the deaths. One thing I want to kind of tell you is that look at how these markets are now macro-driven. The entire rise in the last 1 week or 10 days, it's all because of what's happening in global events. And I would say that that's a trend you should recognize, that this is now an increasingly a macro-driven market. And I think it's going to be in that same nature for the next few years, the next 3 to 5 years. As much as when the mind of the market becomes positive, you see a huge spike in the markets. I think when the mind of the market becomes negative, you will see an equally large gyration to the downside. So that kind of volatility, I think, will continue over the next 3 to 5 years. And that's a change that you must recognize that has been caused because of this new era that I believe we are in with this quantitative easing unlimited or infinity that has been unleashed by the central bankers. I think asset valuations, how they rise and why they rise, need to be understood. And the fact that the volatility as you move forward, given that we are in a macro-driven kind of environment, will even accentuate only as you